In this video, we're going to discuss laying out a structure or a plan for your portfolio, your investment portfolio, if you're looking to get started investing in 2025. My name's Nate. I'm a popular investor on eToro. Thank you to all of those who have followed along and subscribed this year of 2024. And we're going to discuss plans and how you can lay out a strategy and a plan for your portfolio in 2025 based on what I've done for us and our family and for those people that are copying our portfolio on eToro. If you want to get started investing and you have some questions and you want to talk about eToro, put a comment in the video below, in the comments below, and happy to chat, happy to explain more. As always, remember, this is not investment advice. This is not financial advice. These are just my thoughts based on what I've done and what we've done as a family for our investment, our future. I don't know your situation. I don't know your finances and what you're facing as an individual, as a family. And so I can't give you exactly unless I've found out those details and we had a conversation and that kind of stuff. But this is how I like to lay out and structure a portfolio. This is a plan that allows you to have a plan with some flexibility if you want to, okay? But also to go back to the foundations, but it can be flexible if you want it to. So let's lay out how the portfolio looks. Now understand, you're working with 100%, okay? It doesn't matter whether it's $10 or $100,000 or $500,000, it's 100%. So we work in percentages. Yeah. So the biggest portion down here on our pyramid here for our plan, the biggest portion is your cross-sector ETFs or your foundational ETFs. This is 70 to 100% of your portfolio. So I recommend not going any lower than 70% of your portfolio in this foundational area. And the reason for that is if you go lower than 70%, you've got funds elsewhere. And you're breaking some of the percentages elsewhere. Okay, so 70 to 100% in cross-sector ETFs. Now, what is cross-sector ETF? ETF, as we've discussed in previous videos, is a basket or a trolley that holds a lot of different companies. So a cross-sector ETF may be something like the S&P 500 or Vanguard's VTI, which is the total US market. And so it holds companies from multiple sectors. The S&P 500, for example, holds companies from 11 different sectors. So it holds companies that are utilities, it holds companies that are tech companies, it holds commodity companies, all these kinds of things, and they're cross-sector companies. ETFs that are cross-sector are a good foundation, a good base to build your portfolio from. Usually they do well and they are over a period of time. I've got VTI in ours, for example, and for our kids' college we use the S&P 500 for that. Now, why do I say 100%? Because at any time, you may want to bring all your funds back into this section. Okay, so you may decide, based on what we're seeing in the market, we're just going to really be stable and steady as we move through this time period. So at the moment, as of this recording, end of December 2024, right? At the moment, we are 100% in this section of our pyramid. I hold VTI, which I mentioned. I hold VUG, which is Vanguard's growth ETF, and we have our kids' college in the S&P 500. That's all we hold. It's very simple. It's very straightforward. But if we ever want to, we can move up the pyramid if we see opportunities there. That being said, let's go ahead and move up into the second level, which is 15% into sector-specific ETFs. Now, sector-specific ETFs is things like ETFs like URA, which hold uranium companies, or TAN, which holds solar energy companies. Or we discussed one last week, CIBR, which holds 34 companies focused on cybersecurity, right? So in that ETF, you've got CrowdStrike, Palo Alto, Cisco Technologies, other things like that. And that those are sector specific. Now, within this, I wouldn't go larger than 10% towards one sector. Okay, I wouldn't go larger than 10% towards one sector. So you'd have at least a couple sectors here if you're going to use the maximum of 15%. So you could potentially do 3 different sectors. You could do, let's just, for the sake of it, technology, airlines, and commodities, or something like that, right? Find ETFs or cybersecurity, the CIBR, which actually I'm looking into currently. So it's looks pretty decent. But you could do 5% into each of those, and that would match your 15%. Now let's move up a little bit. Okay, we're going to discuss rebalancing here towards the end. Let's move up one more step. Dividend ETFs or income producing ETFs, no more than 10%. The reason I say that is these ETFs are focused on a dividend, not usually overall returns. So not usually, we talk about 15% returns for the year, or 20%, or it looks like this year of 2024 we may be hitting 30%. We'll see what happens. But returns. So the dividend ETFs or income producing ETFs, their focus is dividends, not so much the return per year. So that's why I say no more than 10% of your portfolio in there. Some dividend ETFs that I would recommend is Charles Schwab's SCHD. HD stands for high dividend. Invesco's SPHD, which is a high dividend. It's 50 companies taken from the S&P 500 that pay the best dividend. And these also generally have a pretty decent, not as good as just your growth ETFs and stuff, but have an okay return as well, but they will pay a monthly dividend. One dividend ETF that brings a lot of people in is QYLD. It can pay up to 13-14% annually in a dividend, but the returns, you'll see your capital investment decline, almost pretty much every year. It's pretty much a guarantee, but you'll get a nice dividend payout each month. So no more than 10% in here. You could do 4 ETFs that are 2.5% each of your portfolio. And then finally, up top, 5% in stocks, cryptocurrencies, or your currencies. This gives you an opportunity to see where there's potential for things, and still put some funds in there when you see an opportunity come up. So earlier this year in 2024, when I saw CrowdStrike have their moment, right, where they did an update and everything kind of happened to the systems globally, their stock price obviously took a decent hit. And so when I saw that happen, I waited a week or two, let it settle down, see where it settled, and then I bought in. I saw an opportunity, and from there we saw some good gains. I took profits shortly later. Currencies. The yen this year compared to the Australian dollar was at its weakest since 1990. I was like, well, this is only going one way from this place, really. I bought in. It actually went a little bit lower. I rode it, swept back up. The Japanese government did some stimulus and different things to assist their economy, and went back up, and we took some profits there. And then crypto. We've seen what's happened with crypto just in this year of 2024. For those that have crypto, congratulations, it's been a great return. You may look at trimming some of your position, because now it's probably taking a significant portion of your portfolio, which leads me into rebalancing. Okay, you're gonna have you will have some times where some of your individual companies or some different things where they have a huge gain, and then things lose their balance a little bit. That's where you need to monitor just every few months. When you see something's had a big run, or you see something's happened, monitor it and rebalance it and bring it back into alignment with this. Now, the reason for 5% here is because you're also going to have those times where crypto is going to take a 40-50% hit, right? If it's only a couple percent of your portfolio, it's not a massive chunk from your overall gains. Let's say you have 5% and it's all in crypto, right? And then crypto takes a 50% hit. But your overall portfolio is only seeing a 2.5% decline because it's not a huge chunk of your overall portfolio. This is why I say keep that stuff that's higher risk, a smaller portion of your portfolio. We're in it for the long term. We're in it for the long-term goal, not to try and just get there quickly, right? So this is how I would break down a portfolio, and it allows you to have a plan. It allows you to be flexible within that plan, though. And so this is a structure that I've used, and currently, like I said, I sit 100% in this foundation, and we may actually sit there for a while. And if I see really good opportunities pop up somewhere, I'll look at jumping in there. But we currently sit 100% in this in the cross sector ETFs section. If you want to get started investing, as I mentioned earlier, it can seem very confusing. Put a comment below. Let's do this together. Follow along, subscribe if you haven't already. I'd love for you to be part of the community. As I mentioned, I've been investing for about 10 years now. Invest on eToro. Would love to have you join and connect with me. But I'm happy to help you find out more about what eToro is like and help get you started investing as we move into 2025. Hope you have a happy new year. Hope you have an amazing 2025. Subscribe, follow, and we'll see you in videos throughout this year.